And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show, presented by RIA Advisors.
Okay, I've got 3 favorite Westerns. Well, actually got more than 3. True Grit, Shane, and The Gunfighter. And the only reason I'm bringing up Shane is when he goes, "Come back, Shane. Come back, Lance." This is hard. But we're glad to be with you here, just substituting for Lance while he takes a well-deserved rest this week, although still working, writing. So if you haven't signed up for the newsletter, realinvestmentadvice.com comes to your mailbox every week. It's a big week for the Fed. We'll have Michael on Thursday. I'm Rich Rosso, Danny Ratliff, CFP. Hope you're all having a great day. Well, I don't know about you guys, but Saturday is no longer a day off.
No.
I mean, Saturday is, well, first of all, for all of you out there who, you know, you have a high-level corporate job, heck, any job you have, plus you probably, if you own your own business, every day is a work day. We're always working. Right? Emails are coming in. I think I got one email at like 1:13 a.m. this morning. And I happened to be up at 2 and was managed to address it. But that's the excitement of what we do, Danny, right? We love what we do. We really do love what we do. So for us, it's not really work. It's a blessing to be able to come in and do what you love. I don't know how many people get to do that in the country, actually get to do something that they feel they were born to do. But I think about that a lot. Don't you?
Oh, yeah. Have something you enjoy getting out of bed for to get to work. I mean, and did you go to sleep? I mean, we're going to have to talk about this, man.
I went to sleep at 8 o'clock. I read, I'm reading a new client psychology book, put me out like a light. And I, for some reason, was up at like 1:45, 2 o'clock because I was feeling like my alarm was not going to go off on the phone. Like, you ever get that over paranoia?
Yeah, I did
You're
that
up
at
before
3.
Yeah, right? So you were up anyway. Then I tried to go back to sleep at 2 o'clock. Then the dogs wanted out. I'm like, you know what? I'm just going to get up, write, answer emails, do my thing. And it was fine. So.
And he's on his 3rd pot of coffee.
No, I'm not. I'm only on actually 1.
All right, good for you.
Yeah. So, again, there was some more discussion about stimulus coming, and that was very important. So,
yeah, we did see actually yields on 10-year shoot up quite a bit. So we saw those pop a little bit. So if you're looking at portfolios, one question we get often is, okay, well, how come the market was up and I wasn't up nearly as much as the market? Well, number one, most people aren't 100% in stocks.
Correct.
Number two, those when interest rates rise, bonds, typically their net asset value is going to dip, especially depending on how long your duration is. But there's not a whole lot of places at the moment to hedge, and fixed income. The longer duration seems to be the place to be if you're actually looking for a closer to true hedge versus what we've historically seen.
Well, we have actually moved a little bit from longer duration to more intermediate duration.
That's right.
Because we're not getting the bang for the buck. Now, depending on who gets elected, how the economy shapes up, you might have the Fed purchase on the longer end of the yield curve. So for people that are a little bit more conservative, and we're not saying you should bridge out of where you feel you should, and that's what the Fed wants you to do. If you have a certain risk attitude and you don't feel comfortable owning a specific percentage of stocks, a higher percentage, let's say, than you're used to, by all means, don't go out there and do it. The challenge is trying to get returns on fixed income or bonds. When you think about it, your real rate of return, when you consider inflation, is negative. That is a challenge. Now, we have accounted for that in our planning, but at a day-to-day, that could be a very frustrating process, don't you think, Danny?
Oh, absolutely. I mean, you think about where we've been historically compared to where we are today, and interest rates are really back at these lows.
Yep.
I mean, you have the 10-year sitting at 0.76. Now, we've seen it lower, and I think there's still room yet to move a little bit lower. And I think that there's some opportunity here, but you're not going to see the upside that you once did. It's not going to be the same as coming down from 2% or 3%. we're just not there. That duration play, you can't see the big upside swing on that. But getting a little bit of yield is way better than not getting anything at all, because now we're back to what in money markets? Basically nothing.
Nothing. I mean, we always promote the online banks, right? And they are still doing better, but I think Ally is like 0.6.
Yeah, it's
I
not
mean, but
much.
you're getting 0.01 at your brick and mortar bank. So in essence, you're still getting more, relatively speaking. But
Well, you
yes,
were
yields
always-
have come down. You were always getting more, and you'll
Point-
always
yeah.
continue to get more. But yeah, to your point, the yields are anemic. You're going to have to be creative. You're going to have to rethink your portfolio allocation when it comes to fixed income. There are a few ways to do it. One, well, first of all, I'm just not a big fan of junk bonds. So obviously they have junk bond ETFs. Junk bonds to me, I know obviously the Feds had been purchasing junk bonds, which makes absolutely zero sense. If we want companies to fail, they should be able to fail. But if you're getting 4 or 5%, think about that. You used to get 12, 13% on these types of investments because your principal is at risk. Now everybody feels like the Fed's is going to go ahead and purchase these ETFs or purchase these junk bonds, which makes absolutely no sense in a free market. Why we need to bail out companies that don't deserve it, but that's a whole other story. When we get back, I want to talk a little bit about a few things, but we're going to talk about one, what can you reconsider when it comes to fixed income? And two, is ESG a factor? That's your environment, your government, your social kind of thing. Is it a Wall Street ploy or is it real? Hey, you're listening to The Real Investment Show here on 700 KACV, the voice of Texas.
Very suspicious, writings on the wall. Very superstitious, let us back to fall.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
Who will win the election in November? How will that decision affect your decisions for your retirement? Richard Rosso and Danny Ratliff's next Candid Coffee can answer your questions about money, retirement, risk management, and how to identify and protect your household against financial vulnerability, regardless of who's elected. Send your questions and join this live go-to-webinar event at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso at realinvestmentadvice.com.
Come and shake your body, baby, do the conga. No, you can't control yourself any longer. Come and shake your body, baby, do the conga. No, you can't control yourself any longer.
So, a snapshot of life in 2020. There's nothing like the smell of a freshly washed mask. So I have a cloth mask, and I said, okay, Gain's a very popular scent, even for your car, right? They make little.
Yeah.
So, of course, I put a little. Really good with laundry.
Do
you hearing that, anybody out there?
Pellets or the liquid?
The liquid. I'm going with liquid.
The pellets work.
So when you first put, no, I'm sure they are. I'm just not a pellet person. Just,
had to smell my new shirt.
yeah, pellet people. So I put the mask on and I go, in 2020, it's such a, Eddie Van Halen, come on. Listen,
man.
if Eddie Van
Yeah.
Halen can die, we all can. This is how I look at it. If you haven't gotten your will and your estate plan, and listen, I'm going to tell everybody here, I am human just like everybody else. I have not revised my estate plan.
What?
Yes, in years.
Oh, man.
No, but it's on my now.
Do you need my social security number?
No, but the people who know who they're supposed to be know.
He's waiting to see if I'm done having children.
You gotta make
Didn't
the
want to
count-
keep revising.
keep the count accurate.
Keep the count accurate, yeah. You're not done.
Whoa. Hang on.
That's what she put in
I'm
this
like
coffee.
I'm like Nostradamus. All right, so you really do. Al Green got me. That was bad enough. All right, but all the people who decided to leave town this year, great musicians, man. Eddie Van Halen. I heard he was sick, but wasn't throat
mouth cancer got him.
Really?
Yeah.
His son wrote something very.
yeah.
I know they've been on tour together. Such an incredible talent. But it just shows you that, listen, when these guys are out on stage and you watch Eddie Van Halen, you know what they're thinking. I'm invincible. I cannot die. how can I die? And in some ways, he's not going to, right? His music, who he is going to live on. So he does have the legacy. But the point is, we all think that. Danny, we don't look as we have enough life insurance. We don't think it's important, or we don't get enough life insurance, disability income coverage. In other words, we don't really look to mitigate those risks. That's where a financial plan is, I think, shines, right? Because it really does, even though it will accentuate the strengths, it's also going to show, whoa, where can my plan be derailed? Yeah, listen, it's not a pleasant topic. Estate planning is not a pleasant topic. Well, you know what I noticed with clients, Danny? Once they start the estate planning process, they are all in. They're thinking, once they accept the fact that they're going to make the lives of the people they love a lot easier, they go into it with a zeal. But the point is, they got to overcome that hurdle first. But once they begin, they call me and they go, this is great. I'm glad I did this, because they understand what it means to the people they love and leave behind. So what always happens, with Wealth Management Magazine in our industry, everybody, is when somebody dies, someone can't wait to write an article about how bad the estate plan was. Like Aretha Franklin, horrendous, like nothing, like no estate plan, no trust planning. How much, that is irresponsible, okay? But it's irresponsible in some ways for all of us. So I was thinking about it today. It's like, oh my gosh, my estate plan needs to be updated. Wrote it down. That is something that will be done first part of next year. It's good enough, but it needs to be better. So what's some of your thoughts on this as we see all these great people pass? And
yeah, it does bring it to the forefront. I think the coronavirus has done one thing I think that's good in this aspect. It has made us all face our own mortality in the sense. So, life insurance, for instance, Rich, is actually shot through the roof. People who are actually looking to mitigate risk, they're using term, they're looking at different ways. And I think this is fantastic. This is something that everybody needs to do. And life insurance is something else, just like the estate plan that everybody wants to push off. I don't need it.
I just think people don't really know how much. Like there's all these calculators of, how much reinsurance do I need? And do I just need term coverage, or is there a point where I can bridge to permanent life insurance from term insurance? Is there how do I do this? And listen, it is intimidating. I'm not going to say it isn't. But you can get help and get clarification on how much you need. And
that's right.
And
just
that's
like anything, there's so much information out there. And so there used to be, we talk in all these rules of thumb in the financial world. And it used to be 9 times your income or your expenses. There's so many different ways to look at this.
Lots of rules of thumb, yeah.
But it's also needs to be, how old are you? How old are your children? Who do you need to prepare for? What do you need to prepare them for?
Do you have a business like we do?
Yeah.
How does that go on?
That's right. So you face so many different types of risks based on, what you do for a living. Not only that, but, how old are your children? What about your spouse? Do you want to continue them to stay home if you have young ones at home and be able to prepare for that and for college? There's so many things. So these expenses can add up. Where sometimes we find, especially for younger couples, they're really underinsured.
Yes.
One thing that we see as well, there's a trend that, especially if there's a spouse that stays at home, a lot of times we feel like we don't need to worry about life insurance for them. And that is so wrong.
If you had to calculate, right? Because, my wife stays at home, okay? Mm-hmm. The point is, if God forbid, or my husband, whatever, somebody, I had someone the other day go, well, he stays home. He's the house dad. I'm the main wage earner. And I'm like, well, let me ask you a question. If something happened to him, what happens to you? It's not the money. It's like you need a caregiver to come in. Your whole life has changed. The person who provides care to your children and your home, I think, what is the value? I think it's like $150,000 a year is what you would pay a person like this or something like that. Or, again, to your point, go ahead and continue it.
Yeah,
but it's very important to consider that individual who might be the stay-at-home.
It is. Those numbers are all over the place.
Partner.
And so, if you just Google, you'll find all types of numbers from $13 an hour. If you're hearing this, you have a spouse that stays home, don't ever say that. But, more commonly, we're seeing 150, 178,000. You may not want to tell them that either. Maybe you put the number somewhere in between. But their risk is great. And
Michelle,
so,
you're worth at least 300,000.
way, way more.
Danny
right?
is such a romantic.
He is.
But I'm practical, okay?
He's practically romantic.
Maybe.
Listen, one of the worst conversations I had with my ex-wife, and we're very close. We are friends. As a matter of fact, would be the executrix of my will and all that, right? When she wanted to have another baby, I went, calculate this.
Richard said, with me?
Well, that's what I first said, because it's not happening. Because here's how much it's going to cost. She goes, such a romantic. Such a romantic. Because it is expensive. having children.
Oh, man.
Taking care. It's a privilege. It's great. I wouldn't trade my daughter for anything else. But, I'm like, how many do I worry. We're planners. That's the way we think. We think money first. I'm sorry. We do. It doesn't mean we don't love our children, but we think about, we want to take care of them properly. Why are couples having children when they do, even though there's a baby dearth? So we were having it's like a demographic wasteland out there. Couples are waiting longer. Why? They want to be more financially stable. That's, makes a lot of sense.
There's good and bad with that. We waited a long time. Like you said, being a planner, we waited like 6 years almost to get married. We took a long time with each step because we wanted to plan. We wanted everything to be right. But
and Michelle's a planner too. She's very much like that. I think so. You both
very,
are,
very much
yeah,
so.
So you're good that both. See, it also helps that when you have spouses that are sort of on the same frequency, right?
No, that certainly helps.
That helps.
But I will tell you this. I look back and I saw my buddies who were having kids right out of college, and I think, oh, man, you idiots. You could be out having fun. You could be traveling. Well, nobody had any money back then. You couldn't go do anything. And your kids really don't care what you have.
No,
right?
No.
So that's not, we all think that we need these great things for children when they don't know, if their house is nice.
I'm going to interrupt you because I want to know a number from you. How much to take 3 kids to Disney for like 4 days?
I don't know, and I don't care because I'll never go.
Okay.
No,
I'm just telling you guys. That's why I know it's expensive, because that's what Danny says, and that's why I interrupted him, because I wanted to hear.
I can tell you this. I had a buddy about a year or two ago ask. He's like, "Hey, we're gonna go to Disney. You guys should come with us." And I was like, "Okay, how much have you spent?" I said, "What have you done so far, and how much have you spent?" The number was like at 11,000. He only has 2 kids, and I was like, "Nah, I don't think so." The thing about Disney though,
Danny went and bought a Mickey Mouse costume and ran around the house.
Oh, dude, you know it. Absolutely.
Hi, boys and girls.
So the craziest thing about that is that one of my best friends,
by the way.
took his kids to Disney.
Yeah.
And he gets home like 2 weeks later. It's an expensive trip. And his Disney commercial pops up and his son's like, Dad, I want to go there. He's like, what? What do you mean you want to go there? I just took you. We just got back. But he was so young. He just
you also got to think about the age. Like I took Haley when I was thinking about what age do I take her? So at least she remembers. Mm-hmm. She was like 8, and I'm like, okay, maybe she'll, sort of remember.
Right now may be the perfect time, though, Rich, because maybe they have like a virtual Disney World I can take them to. We could be on to something here. I'm glad you brought that up.
Dude, I bet they do. You put on the headphones, the headset, and, Disney and all, everything's right there, kids.
Man, that'd be perfect. Then you won't have to have It's a Small World in your head for the rest of the week.
You know what? I bet Disney would be more fun with my kid now at 22.
Oh, way
Haley,
more
when
fun.
are we going?
Way more
You're
fun.
paying your half, buddy. All right, we get back. We want to talk about the 10 best countries in which to retire. U.S. Number 16. From the Natixis 2020 Global Retirement Index. We'll be right back here on The Real Investment Show. Stay tuned.
The sun or the rain can be like they are. Come on, baby, feel the reaper. Baby, take my hand, feel the reaper. We'll be able to fly, feel the reaper. Baby, I'm your man.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.
Who will win the election in November? How will that decision affect your decisions for your retirement? Richard Rosso and Danny Ratliff's next Candid Coffee can answer your questions about money, retirement, risk management, and how to identify and protect your household against financial vulnerability, regardless of who's elected. Send your questions and join this live go-to-webinar event at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso at realinvestmentadvice.com.
Baby shark, baby shark, baby shark, baby shark, mommy shark, mommy shark, mommy shark, mommy shark, daddy shark.
Is that Mike's theme song?
Yeah.
It is. It's my walk-up song.
That's your walk-up.
Yeah, we're going to have to get rid of that, Mike. Still brings bad memories over here.
Got to find a song with Fed in it.
Can we do a Halen song?
Is there a song called Fed Up? That would be for Mike. That would be a great shirt for him for the holidays. Fed Up. So thank you for joining us, Mike. We appreciate that. Great new article yesterday, right? That you posted?
Yesterday. Yep. Yes.
It's the Fed Gaslighting. You had all kinds of great stuff in there. And you mentioned something about integrity, which is sort of weird when you put that in with the Fed.
Or lack thereof.
Or lack thereof. So give us your assessment of the minutes. What are your thoughts? It seems like the Fed is scrambling around to try to figure out what this new policy is. What is your assessment of the whole thing?
The Fed, I think, is getting desperate. The Fed knows that their actions really have very little effect. And that's even more so today than it's been because rates are so low. The lower rates get, there's just less need or desire to borrow money, right? We've had so many chances at lower rates that the marginal benefits of lower rates is next to nothing, right? We've had zero rates for the last decade, give or take the last few years. Mm-hmm. So the benefit of lowering rates is minimal. We've seen a boost to the housing market and the auto market, but the benefit is, there is some benefit, but it only lasts for so long, and the Fed knows that, right? And QE, other than propping up the stock market and asset prices, has almost zero effect on the economy. The whole concept of trickle down is a joke, and that's been proven now for 40 years. So what can the Fed do? They can try to talk things up, right? And they certainly are good at that. That's gaslighting, essentially, right?
That's right.
It's creating a false narrative with false logic to try to get the people to believe something. But what I think they really want to do, and I think one of the purposes of QE is to allow the government to run these deficits that are unheard of, right? In 2008, 2009, Obama ran a deficit in the, just under $2 trillion, and we all thought that was crazy. Now we're running something almost double that. And, this is totally unsustainable except for the Fed. The Fed buys this debt. They keep interest rates abnormally low, not just for U.S. Treasuries, but for pretty much any half-decent borrower. And they it's not that they're keeping the economy and the recovery going. They're keeping the whole economy from collapsing because the pressure is that interest rates need to rise. That's really what should be happening. But the Fed is pretty much buying all the treasuries out there. And now they're running into a problem. And they keep begging. If you listen to every Fed speech over the last 3 or 4 weeks, including Jerome Powell at the last meeting, they're begging for Congress to come to an agreement on stimulus.
Yep. He keeps throwing that in there. Yep.
They're literally begging. You got to do it. Dire consequences if you don't do it. We got to do it. We got to do it. We got to do it. And there's a couple reasons he's saying that. A, because he knows that fiscal stimulus will help prop up the economy. It's propping it up in a weird way. I heard you guys talk about the K-shaped recovery. It's helping some, hurting others. But, they're looking at overall appearances, and GDP looks good, and inflation is rising. So they think it's good for everyone, where it's clearly not good for everyone. But they can't do QE if there aren't bonds to buy. And at the pace they're going, if we got back to our old deficit of only $1 trillion, or slightly less than $1 trillion or slightly more, there aren't enough bonds for them to buy to do what they want to do. So they need the Treasury to continue issuing $2 to $4 trillion of, a deficit, to fund a deficit so that they can issue their debt, so that they can buy the bonds. So,
it seems like a spiral down that we can't, I mean, to your point, the Fed can grease an engine, but they can't totally repair it, right? So they only have a couple of guns and they're fighting Godzilla. So I think it's great how you tie in what they're really trying to do even on the fiscal side. And yeah, it's almost like Powell is begging, if you don't do this fiscal stimulus. I've never really heard this from a Fed official as of late. I mean, they bring it up, we don't do this, and yeah, it would be great. But he is pressing hard on the fiscal stimulus.
So, Mike, is this? These are the unintended consequences of a decade of bad moves by the Fed, because we had opportunities to raise rates previously, and now we're stuck in a position where, I mean, you can't raise rates right now, and yet, so now you have to keep printing.
Honestly, Danny, it's about 30 years of bad Fed policy.
Yeah, true.
What happened 10 years ago is when rates hit zero. So they used to just adjust interest rates up and down. And, I remember taking out my first mortgage, which was at 7 or 8%. And then rates got lowered to 6%, and I got to refi, and I was like, wow, this is incredible. I got an extra $50 every month to spend. And that worked till we got to 2008 when rates got to zero. Interest rate, U.S. Treasury, short-term rates got to zero. Mortgage rates got down to, I don't remember where, 4.5%. Again, everyone got the gift from the Fed. But at that point, that's when the game ended. They couldn't lower rates anymore unless they wanted negative rates, which we have seen in Europe and Japan. So they go to QE. And QE is not a very effective tool. It's an effective tool to keep interest rates where they're at or slightly lower, but it's not an effective tool for the economy. And, again, back to the K-shape, because that's a big deal. Why are we seeing some of this social unrest? I think this goes well beyond police actions. I think this is economic, right?
Yep.
And it's not just poor people. It's not just poor people in the slums. This is the middle class that is getting killed. And the percentage of the population that is on the other side of the Fed trade is growing rapidly, because most of us don't own stocks. And those that, and for those of us that do own stocks, for a lot of us, it's just in our 401ks, which we can't touch till we retire. So the percentage of people that really own stocks in any kind of meaningful quantity that can use that wealth today is really small. And they tend to keep it in their portfolios. They don't withdraw to spend it. So the wealth effect of a rising stock market is not that effective. And that's what the Fed's doing. They're keeping zombie companies in business. And you look on the fiscal side, the big debate now is, do we bail out the airlines or do we bail out the municipalities, or both? That's how you end up with this K-shaped economy. If they bail out the airlines, again, they're on the upper side of the K, and the munis are on the lower side of the K. Both munis and airlines hire people. They both have employees. It's, it becomes politics at this point, and it's, this is the ugly side of stimulus, is that the government decides who the winners are and who the losers are. And the Fed, even though they're not elected officials, have taken on that same role. And, it's honestly sickening, and I wish I didn't have to write or talk as much about the Fed, because what we should be doing much more is talking about stocks and finding companies that are cheap and selling companies that are expensive, and not having to deal with markets that are totally dependent on the Fed. I feel like I come on your show, I'm like the weather guy. And it's Mike Lebowitz on the 8th to talk about what the Fed just did.
But it drives, to your point, the Fed drives asset prices first and foremost. So it is very important, and we need to look at that as well. When we get back on The Real Investment Show, more with Mike Lebowitz this morning on 700 KCV, the voice of Texas. Don't go away.
Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Who will win the election in November? How will that decision affect your decisions for your retirement? Richard Rosso and Danny Ratliff's next Candid Coffee can answer your questions about money, retirement, risk management, and how to identify and protect your household against financial vulnerability, regardless of who's elected. Send your questions and join this live GoToWebinar event at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso at realinvestmentadvice.com.
Welcome back to the Real Investment Show. I'm Danny Ratliff here with Richard Rosso. Hope you guys are off to a fantastic day. So talking about fixed income and where to go next, I think this is the million-dollar question. We keep getting, we get a lot of different questions, but this is one I think that is on everybody's mind with yields as low as they are, where things have kind of gone here recently. Mm-hmm. Where do you go, Rich? I mean, this is something that, I think there's a lot of fear that, one, we just talked about how, it's not the hedge that it previously was because yields are already so low.
Yep.
And historically, when we see markets, some disruption there when markets typically go down, a lot of times, not always, but a lot of times you'll see some pressure on yields as there's a flight to quality. Maybe the Fed stepping in, they're purchasing treasuries, a number of different reasons. But this is something that, this is a hot topic in our investment committee meetings on a regular basis on where do we go from here? How do you protect clients' assets? And how do you still get some type of generate some income? And so there are a handful of other ways that you can look at this.
Well, we look at, for example, we are using certain ETFs, but you got to watch them closely, like the MBB. Mm-hmm. So you have in there investment-grade mortgage-backed pass-through securities and also government-backed. So I think that's maybe about a 2.3% yield. You can look at intermediate corporate ETFs by Vanguard and so forth. You might get around 2% or so. But again, you're going to have to reset your expectations. If people are looking to say, hey, I want to live on the income from my portfolio, it's going to be very tough unless you venture into stocks or a more creative option. Now, again, you don't want to venture into stocks if you don't have the stomach to do it, because at the worst time you will sell. The other thing we're going to start to see now is people start to muddy the waters between bonds and dividend stocks. Stocks that pay. And we've tried to focus on building up cash flow through dividends in our equity portfolios. But I will tell you, you're going to have a lot of investors desperate enough or feel complacent because of the Fed backing up markets to go ahead and look at dividend stocks as replacements for bonds. Stocks are not replacements for bonds. Okay? They are not the same level of risk.
Wait, say that again. Because I think, this is so important to remember.
But I hear them even say it in mainstream financial media, that dividend stocks are bond replacements or substitutes. Once you start to cross that bridge, it's very tough for your brain to go back. These are not bonds. These are equity investments. You are going through a period of time as well where you can get very seduced by yields, where you only look at what a company yields to you and you don't realize how that dividend is derived. And through these periods of stress, which no way is it over, these companies can cut their dividends. Lance has talked about this for years. We have just seen it happen with companies we thought would never cut their dividends, right? So if you are going to cross that bridge in your mind and feel comfortable with it, you really need to step back, don't you think, Danny, and understand, how's that dividend? Where's it coming from? Is it safe? And these are not bonds. If bond yields go up, like we saw treasuries, right? Just say bond yields go up to where they look sort of attractive and bond and stock money starts to compete. I don't know if that's going to happen, but say it does. You will see money come out of stocks.
Oh, yeah.
And go into bonds. And then you're over there stuck owning a dividend stock from a utility. And you're like, how could this be down 15%? This is what happens. So people don't do their homework. I just noticed they go, well, I looked at this yesterday. The yield's 8%. Did you look at how they get 8% in this environment?
This is really important. So how many times have you had somebody come to you as well and say, okay, Rich, I've looked at these stocks. They've never cut their dividend. And they've actually gone up in bad times. Mm-hmm. But these are the same people who would typically sell at the bottom. And so why did they go up, though? They went up because the share price decreased.
Right.
So you have to remember how actual dividends are paid. They're not just paid on a percentage basis. They don't say, okay, XYZ stock's going to pay you 3% regardless of what the share price is. No, they're going to tell you how much they're going to pay per share, which is going to impact that percentage going up and down. Mm-hmm. And that's one thing I think that a lot of people fail to remember on how these things are actually paid. And so,
but I expect a lot of sell-side analysts, financial pundits start pushing this stock replacement for bonds, just like they're going to use real estate investment trusts or REITs. You know what my grandmother used to hang on the door at Christmas?
What's that?
REITs. That's what she used to say. Instead of wreath, that's what she would say.
It was to impress the Utes.
Yeah, no, but this, Grandma said, we're going to have a REIT for the door. I'm like, oh, okay. How much does it pay? So you got to remember, REITs are also not safe.
Hey, I'm all for this shift, though. I mean,
if you want to do it and you've done your homework and you've done all the due diligence and
well, I'm all for it for different reasons, in the sense that not that hey, you flip your bond exposure for large cap value per se, those dividend payers. Mm-hmm. But I'm all for it because I think that's where the market inevitably ends up going, because this looks so similar. If you study the markets and you see the things that have happened, you look at all the things that are going up over this last 6 months. And what has it been? It's been a handful of equities. It hasn't been this large, whole market encompassing event where everything's going up. No, it's a handful of things that are driving the market.
But it's been growth. It has been growth. If you haven't owned tech, you've been in trouble. And obviously some of these heavy dividend stocks haven't
performed.
Now, if things calm down, I think investors do start looking and getting seduced by yield. And I'm already hearing it. We have enough clients or enough people we talk to every day that it's starting to brew, and I'm getting the verbiage, oh, well, this could replace my bonds. And that's when you have to have the discussion. This is where you need to have the discussion with yourself, and don't fool yourself because you need income, and I get it. By just saying, I'm just going to buy dividends and I'm only going to look at the yield. You really do need to break out the cash flow statements, income statements, dividend histories. I mean, you got to do work to figure out which ones might at least keep it. And in this environment, Danny, I mean, I don't know. You never know which company is going to cut their dividend.
Well, I think that we're seeing this kind of coming in waves, where this is almost like a rolling recession to some extent. Initially you saw the service industry hit so hard and still there today. Yeah. Trying to claw their way out. I don't think there's more stimulus. I think this next month or two we're going to see some bigger issues. More signs on doors that say, "Hey, closed," or "for sale," for that matter. And when we think about the portfolio, you need to think about it as a portfolio, not just an investment. And what I mean by that is that you do things for different reasons. And so sometimes you may buy a position or buy something to hedge off another one. And it's not all about the old school modern portfolio theory. I hate to tell you, modern portfolio theory was great back in the day when we had true diversification, when markets weren't so intertwined. But that has changed drastically.
It was never even designed for retail investors, but we're not going to even get into that rabbit hole.
Yeah.
But to your point, if you want to look at dividend stocks and you say, listen, I have 25% in equities and I want to go up to 35% and you want to find dividends, do your homework. Actually, if you look at RIA Pro, for us, we do a lot of homework on this, right?
We do.
So maybe we can circumvent that. Nick Lane writes a lot of great reports for us on individual stocks that he posts on there as well.
Yeah, so, Value Seeker. Go follow it on Twitter. Go look online. Lots of great information out there.
But you've got to do your homework. It's not just yield. And people will be looking at closed-end fund yields and so forth. It's not like you can't consider them. You just need to understand how these yields are derived. and if they're derived from leverage and things tighten up again, then all of a sudden your share price can plummet. You've got to be careful. It's not just the dividend yield, but it's principle. Dividend stocks are not necessarily safe, just as REITs are not necessarily safe. In this environment, I don't know what is safe.
So Rich,
So
clearly
Yeah.
dividend stocks are not the same as fixed income. All right, we've got
Did
that.
we say that? Yeah.
We've got
We've
that.
just nailed that one.
But what's another alternative? Where can we look for yield? Where can we look for maybe safety? Because I think that's still going to be important in this next move we see in the markets.
Well, I know this is the A word, but this is called the annuity, right? An annuity where you maybe look at what we call the fixed indexed annuity. Mm-hmm. And Roger Ibbotson, who's a longtime analyst, right, writes a lot of stuff in finance, talks about how you can possibly use fixed indexed annuities as bond replacements. What a fixed indexed annuity is going to do is it's going to allow you to diversify or look at tying into certain moves in the S&P 500 or the international index. Now, sometimes those formulas are difficult to figure out because you're like, well, what kind of formula do I go into? Like, how much of the upside am I going to capture? The point is, though, generally speaking, the upside, for the most part, is capped. So even if, say, there's no cap, they're going to say, listen, you're going to get 25% of whatever the upside is of the S&P 500 from the day you invested to your anniversary date. Okay. What's most important about this? And this is why they're called fixed indexed annuities. There is no downside risk.
Say that again? What? No downside risk.
Well, if the market goes negative on the S&P, I may not
Correct.
earn anything, but I don't lose. And if they're planned properly, they can be a sleeve or a part of your allocation. We'll talk about this when we get back on the Real Investment Show here on 700 KSEV, the voice of Texas.
I'll be here till the end of time. So you got to let me know. Should I stay or should I go?
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Welcome back to the Real Investment Show. I'm Danny Ratliff here with Richard Rosso. So spent last couple segments talking about bond yields, where to go from here, how to recreate maybe a little bit of yield or find alternatives. So, moral of the story, want to wrap this up is make sure you're using a plan. You know what you're looking at. Do this from a holistic viewpoint and, be cautious. Look, there's a lot of things. We talked about annuities. We think these can be used when they're planned, not sold. They can be fantastic. A small portion of a portfolio, not everything. And that goes for many things that we invest in. We need to be cautious, but there's lots of different types that can get confusing. If you have questions, go to realinvestmentadvice.com. Go to ask a question. We'd love to help.
Yes.
A lot of times we get somebody who just has one say, hey, I'm not sure if I'm using this right. Send it over. We'll help any way we can. But I want to spend a little time talking about ESG funds. These have gained a ton of traction.
I don't like that in my food. ESG gives me a headache.
Yeah, of course. So that stands for environmental, social, and governance factors. And
These are hot, Danny. These are the hot things. These are so hot.
They're hot because we can package them, and it's on par with what's going on in the world, right?
Well, listen. These funds have accumulated $71 billion of inflows globally from April to June. And assets under management are $1 trillion for the first time. But here, listen to this. These might be some of what you may all remember as socially conscious types of funds. Yet these funds will have Microsoft, Apple, and other big companies found in non-ESG funds. Because now I will tell you, Wall Street has picked up on the fact that millennials, right? And Gen Zs, even my daughter looks at this, corporate governance, are going to start to look at this, right? We want low carbon, water, clean energy, solar investing, gender diversity, minority empowerment, faith-based, which is one of the first, have been faith-based investing. But keep in mind, the Wall Street marketing machine is hard at work to sell you these things and slice them and dice them any way they can. And then when you look inside the portfolios, you wonder, how did this company get into this ESG? So is ESG a factor? Is it a theme? What is it, Danny? Is it just that's my stand on things and I'm willing to do that and take that stand even if it means lower returns for me? This is a growing evolution, right? This is the future of how younger people want to invest. And it's going to push corporate governance to change, to be better stewards for their employees.
Which I love.
And the environment, yes, compared to just shareholders, which, by the way, has not always been that way. There are a lot of great books in the 40s and the 50s of how companies treated their employees. I'm still in shock by what these companies did for their employees. Created whole towns around them, right? You had CEOs of
companies. Just so they couldn't leave, Rich.
Yeah.
So they could
they
work.
couldn't get out, right? They always had to work.
They have like,
like what Connie does. They have those cameras on you at all times, right? But most important is the CEO of GE at the time said, our employees and customers are more important than our shareholders, and was lauded for it. So since the pandemic, this ESG theme has exploded. But it's also been in the grips of the Wall Street marketing machine to slice and dice these into ETFs and mutual funds that will charge you more, and yet the performance isn't there. Nothing wrong with wanting to be socially conscious, looking at clean water, corporate governance. The tough part is, how do you actually fit it into a portfolio? Is it actually something that can be measured? And some of the best companies out there that do analysis can't figure it out if it really is truly a factor of something you can actually look at and measure yet. There's so new.
There's no set parameters surrounding this, right? Each fund can rank a company differently, which means that you could have an Xcel Energy in one fund because they're looking to go completely carbon free by 2050, and they're leading, in wind generation facilities. But if you look at their current carbon footprint, it could be huge. So one company could say, wow, this is great. These guys are moving in the right direction, where another fund may view it differently. And so this is why, like you mentioned, you have to look underneath, look inside the portfolio, see what they actually own. And the thing is, I think at the end of the day to remember is that this is a packaged product. This is something that Wall Street does a fantastic job doing, putting something together based on current sentiment. And a lot of times we feel better because we invest in these areas. But I wonder if you invest for so long in something, because look, ESG funds are nothing new. They've been around.
No, they've just morphed and exploded in what they do. But these faith-based, socially conscious, sometimes I would be confused because I'd look at some of the socially conscious funds and I'd find tobacco companies in there. Like, what are the parameters, right?
Wells Fargo.
Yeah. So
Wait a second.
So now what you're seeing is, for example, there's this Adesina social justice all cap global ETF, right? You have impact shares, NAACP minority empowerment ETFs, SSGA gender diversity index, symbol SHE, SHE. They haven't really brought in assets yet, and their performance is not there. But what you're starting to see is Wall Street is going to try to figure out how to slice and dice this and appeal to your emotion when your goal is really also to try to get returns, right? You still have to put the same parameters to work, even though your heart is in this. You really need to look at whether or not these are worth your time. So people are asking this question. Will these factors, is this a real factor? Will it deliver? Heck, I think it's too early, but I will tell you the press is hard and fast on ESG, especially since the pandemic and what we're seeing.
It is, and I think as the world gets more politicized and as we get, more divisive in some ways, people are beginning to say, hey, I'm going to speak with my wallet. A lot of people don't like to speak out, but they may say, you know what, I'm going to patronize certain types of places. I'm going to give my money to certain places. We've even had clients who say,
see, that's a better way
we don't
for
want
me
to
to
restrict
understand it. Or corporate governance, what I think is going to happen like in annual reports, say, you're going to start to see as Gen Z starts to invest and millennials are now embracing stocks more than they have before, you're going to see more companies doing things that would fall within the corporate. See, I think the corporate governance part is the easier part. The social justice part, gender equality part of investing, I don't know what the metrics are going to be.
well, everybody's
something
perception's different on that, right?
Right, exactly. So you look at this SHE ETF. It was launched in March of 2016, believe it or not. It has $134 million in a strategy focused on companies that employ women in high-level leadership roles. It's up. I mean, it's gained 11% this year, but it's very thinly traded. So you might even come up with a rule for yourself and say, listen, I'm going to have my own rules here, whether I'm going to invest in stocks, look at how I would go from the corporate governance first, because, Danny, if the corporate governance is strong and they care about community and so forth, I think you trickle down into the environmental and the social. I don't think it's like side by side. I think it's top down with corporate governance first and how corporate runs that governance, and then moves down to the environmental, because I think all that sort of falls together. So
you just said something really important, though. You talked about, well, you did, yeah,
Danny,
volume.
Brent, did you hear that? Oh, okay.
Record it. Oh,
Got
wait,
it on
it is.
tape.
Yeah. So,
Remember
but
this?
you did. So volume, I think that is a big part of this. And I think that a lot of times if we're investing, look, most really intelligent investors, they already know about these spaces. They know what they're doing. They're not, and that's not who they're advertising these funds to. But you have to be cautious, because if you have something that's traded very thinly,
Yeah.
and you want to get out, you may not be able to. You may not be able. There may not be a buyer on the other side. Then what happens? And you're stuck. And so that's what scares me more so than any one of these particular themes, because I don't think they're necessarily right or wrong per se.
They're not. They're just hard to measure.
They're hard to measure.
And know whether or not you're going to really get returns. So you might want to come up with a rule. Say you create your own investment philosophy. Like I would help my daughter do this and say, okay, if you're not going to, I'm trying to get her more investing in individual stocks, but she's very socially conscious, right? So maybe she says, I'm going to have an investment like this, but it's only 1%. Like come up with a rule in the portfolio. So if it really underperforms, at least you feel that you've done something.
Yeah.
Because this is where we're going, folks. I just don't know. Right now, it's so early in the process, and the Wall Street marketing machine is going to be 10 years ahead, and it's going to blow stuff up, rethink it. Just as long as it captures your dollars, that's all they care about. We care about that you understand how these work. You're going to be hearing a lot about these investments as we go forward. And I think especially if it's a Biden win, then you're going to hear more and more about this because of his emphasis on clean energy.
That's right. It's going to be huge.
You're going to see stocks and so forth that have that green energy tilt. And obviously, some of those ETFs that have been around, solar, they've been around for a while. There are a lot of clean energy ones. They've done well. But they have been around for a very long time. They've gained volume. But these other additional factors or determinants, they are nebulous. And tough to grasp. But I will tell you, the money is flowing into these. But you do need to, and I think to me, it's an emotional buy. And of course, investing is all emotion. I know it's math, or we tell you it's math. Yeah, it is. But for the most part, it's animal spirits in the short term. These really tug on you for people that are feeling the strife and things that are going on with the pandemic. This speaks to them very well. So it is a very powerful theme for women, millennials, Gen Zs, and I believe Gen Xs. They are going to look to prioritize ESG in their portfolios over the next 2 to 3 decades. But right now, you're stepping out into a little bit of no man's land, and you got to be careful.
Yep, I agree. So lots to talk about still yet, but we do have to go. Tomorrow we're going to be talking a little bit about who needs a plan and when you need one. I think this is really important. It's not when you retire, hint, hint. So, hey, I hope everybody has a great day. We'll see you tomorrow morning at 6 a.m. Have a great day. You listen to The Real Investment Show. Thank you.
Money, money, must be funny in a rich man's world. Money, 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 always Sunday in a rich man's world. All the things I could do.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.
It's a rich man's world.